This LOS is Describe the Portfolio Approach to Investing. Portfolio diversification, avoiding disaster and reduce risk. Diversification helps investors avoid disastrous investment outcomes. In addition to avoiding a potential disaster associated with overinvesting in a single security, portfolios also generally offer equivalent expected returns with lower overall volatility of returns, as represented by a measure such as standard deviation. Evaluate investments based on their contribution to risk and return of an investor's overall portfolio, not in isolation. Adding a risky asset can actually reduce portfolio risk, and we'll see that in later LOSs. There's the diversification ratio, which is the standard deviation of portfolio returns divided by the average standard deviation returns on portfolio assets. So this is the last slide for this LOS, and it's just a bit of history, the emergence of modern portfolio theory. The concept of diversification has been around for a long time and has a great deal of intuitive appeal. However, the actual theory underlying this basic concept and its application to investments only emerged in 1952 with the publication of Harry Markowitz's classic article on portfolio selection. The article provided the foundation for what is now known as modern portfolio theory. The main conclusion of modern portfolio theory is that investors should not only hold portfolios, but should also focus on how individual securities in the portfolio are related to one another. In addition to the diversification benefits of portfolios to investors, the work of William Sharpe in 1964, John Littner in 1965, and Jack Trainer in 1961 demonstrated the role that portfolios play in determining the appropriate individual asset risk premium, i.e. the return in excess of the risk-free return expected by investors as a compensation for the asset's risk. Again, that's the last slide for this LOS.